Aditya Khemka, who is now joining us to talk more about that. Aditya, afternoon. We're talking after a long time. Good to see you. Did you catch Dilip Sanghvi's Sun Pharma, Dilip Sanghvi's speech in the Indo-US Chamber of Commerce and the kind of growth outlook he's given for the Indian pharma space, and especially on the specialty and the innovation side, on R&D side?
Yeah, good afternoon, Ajay. I did catch the interview. So I agree with Mr. Sanghvi. Many of the Indian pharma companies are making a credible effort to move away from generics and to diversify into innovation products, and that seems to be the way forward. However, a point of caution here for investors: innovation, unlike generics, has a very low hit rate. So just because Sun Pharma has been able to do it once and may be able to do it again twice or thrice, it doesn't imply that every company would succeed.
Aditya, how's your universe panning out? Let's start with diagnostic today. We usually focus too much on large pharma names. Krishna Diagnostics, just half an hour back on my show, told us that they are looking at almost 1,000 crore of top line by 26 with a 30% kind of margin. When I looked at the market cap, it's trading at 2,000 crore. It appeared that the way diagnostic space over last few years have got completely re-rated, such high growth names, or is it the numbers are very somewhere it looked like a mismatch? How do you see that name? You have it in your portfolio, and I want to talk a little bit about its business model in the diagnostic space. They have tied up with state governments and setting up a lot of infrastructure.
Yeah, Ajay, so according to various industry estimates, 50 to 60% of the Indian healthcare infrastructure is owned by government. However, it takes care of only 20% of the paying patients. What that basically tells you is that the patients who want to pay don't want to go to government facilities, and I think that could be largely because of the inefficiencies in the way these facilities operate. Now, this is where a PPP model comes through, where government is basically appointing private players like Krishna Diagnostics to manage the facilities which the government already owns. Now, this model, I feel, is relatively new. I don't think it's more than 10, 15 years old in our country, but it has worked very well. If you look at Krishna, it has achieved a revenue run rate of close to 600 crores after 12, 13 years of operation, if I'm not wrong. So that itself tells you that it is scalable, it is profitable, it is a decent ROE business. And I think this business has a lot of scope for growth. If you look at Krishna, they're today in 17 states. And there are many more states to go. And each of these states, it's a dipstick approach that the states take. So they would initially give you maybe 5, 6, 10 facilities, 15 facilities to manage, while the state might have 200, 300 facilities, So they see what kind of results you are able to produce in those 15, 20 facilities that initially give you. And if they're satisfied with how things have changed under the PPP model, they will, give you more facilities. So as an example, in Rajasthan, their first contract, which I think expired in August of 2022, it was a 70 crore annual revenue contract. And the renewal of that contract, which is due any time now, it would happen, and Krishna estimates that to be 250 to 300 crore per annum revenue contract. So you're talking about 4x the previous annual revenue, from the same state. So which is, I call it a dipstick at this stage. So yes, it's a very scalable model. It's a model that has a lot of merit to it. It's a model that helps democracy, that helps poor people who cannot afford private healthcare. And it's good for the nation, it's good for the company as well.
Right. Aditya, what else is looking good to you on a risk-reward basis beyond the most obvious large names? Companies which have been investing a lot in their business models for some time now, and now the earnings may be coming at inflection points, something which the market is missing out on. Basically, risk-reward wise, which are looking attractive to you.
Yeah, so I like the diagnostic space the most at this point. Our two diagnostic holdings are Krishna and Thyrocare Technologies. The reason why I like diagnostic more is because all these diagnostic labs post-COVID have invested a lot in their business models in terms of expanding footprint, improving quality, creating new channels. And those investments, although they appear on the P&L over the last 2 years, the revenue, the commensurate revenue of these investments don't appear on the P&L yet. And we expect that to happen over the next couple of years, these revenues to come through. Now, because the cost is already on the P&L and the revenue will come later, a majority of the revenue will flow down to EBITDA and profit before tax. And that, I think, should help diagnostic stocks do extremely well over the next 2 to 3 years, is my view. Post diagnostics, I like branded generics more. Because in branded generics, the raw material cost was escalated from China over the last 2 years because China was not able to produce chemicals and chemical prices shot up. And that sort of hurt branded generic margins over the last 2 years. Now that China is back in full steam production, raw material costs are coming down. But mind you, most of these companies have 6 to 12 months of raw material inventory. So even though the raw material prices just start coming down, let's say 9 months back or 10 months back, the full impact of that hasn't been seen in their P&L yet, because they are still consuming the high cost inventory they acquired over the last 2 years. And hence, I would say that the next 2 years for the branded generic companies would also be margin accretive years, where the low cost inventory will reflect in their gross margins.
Right. Aditya, what's the story developing in Jubilant Pharma Nova? I remember there was a time when there was a massive interest from big HNI in this name, but then suddenly all the interest died down. Did the numbers not pan out, or the business hypothesis did not come about? Can you tell us how are things developing there on the business front?
So Jubilant Pharma, Ajay, is a conglomerate. They do 7 businesses. Out of the 7 businesses, I think in FY23 ending, 3 of these businesses were loss-making and 4 were profit-making businesses. We also look at Jubilant Pharma as ancillary to diagnostic industry. Their largest business is the radiopharmaceutical business. And these radiopharmaceuticals are used when patients go through MRI, CT scans, and other kind of scans. So we look at it as a diagnostic ancillary itself. And the 3 loss-making businesses which they had in FY23, a couple of these businesses have already turned around in FY24, and the remaining 1 or 2 businesses will turn around in FY25. And that should result in higher profitability growth than top line growth, because your loss-making businesses are giving you profit, whereas your profitable businesses continue to grow. To add to that, Jubilant Pharma also fits into what Dilip Sangvi had said in that symposium, where he said that innovation is probably the way forward. Jubilant Pharma has already launched an innovative product called Rubifil in the diagnostic market. There another innovative product called MIBG may come into the market in FY26, 27, depending on approval timelines. And it's a very niche market. It's a very niche, limited competition area, and it can have a large addressable market. So I think Jubilant Pharma is again one of our top holdings in our PMS, and we are very optimistic about the company's future.
Within hospital stocks, Aditya, which business model do you like? The pan-India and national business model? A lot of regional, biggies are also emerging, which are kind of takeover targets as well sometimes, but are much more efficiently run, a very tight ship. Some of the names in the south. Within hospitals, which are the names which you like? You may or may not have them in your portfolio.
No, the 2 stocks that we hold in our portfolio and that we like are Healthcare Global and Aster DM Healthcare. Now, Healthcare Global we simply like because that company is a super specialty oncology company. Cancer as a disease profile in India is growing faster than other diseases, and it is still expanding. Given the westernization of our lifestyles, cancer will continue to grow as our expectation. And when you get a terminal disease like cancer, our understanding is that a patient wants the best quality care, and who else can give you a better quality care than a super specialist himself. So which is why we like HCG. Also on the valuation side, we believe it is significantly cheaper than some of the peers which are multi-specialty. And globally, if you see super specialty hospitals trade at a premium to multi-specialty, whereas in India it's the opposite. Multi-specialty hospitals tend to trade at a premium to super specialty. I think that will change over a period of time as investors understand the 2 business models better over a period of time. So that's HCG. On Aster DM, we like Aster DM because although it's regional, it's mostly southern and slightly western India. It's not there in north and east. But we like the hospital because they are doing aggressive capex. They are growing fast. They have already spun off the GCC business, which was sort of a non-strategic business for the Indian shareholders. And they paid out significant dividends to the shareholders, signaling a very good intent of the promoter and alignment with the minority interest. And again, in terms of valuations, I think other than HCG, there is no other significantly large hospital trading at the valuations that Aster DM is trading at.
Aditya, I'll let you go on that one. Thanks so much for your time today.
Thank you, Ajay.
That was Aditya Khemka of InCred PMS talking about the various positions and also sector, healthcare, diagnostic, some pharma names. We'll take a short break. On that note, more news and
If you like this video, then like, share and subscribe to ET Now.